Welcome to the first episode of CareEdge podcast called InsightEdge. I'm your host Revati Kasture, and as we bring together industry leaders, experts, what we plan to do is bring you a plethora of knowledge, information to discuss opportunities, challenges that are there in various segments or sectors, and offer you insightful views and engaging conversations. Today we have Mr. Amara. We actually have the honor of having Mr. Amara, the Managing Director of State Bank of India, the largest bank in the country. And just to give you a little bit perspective on State Bank is largest bank in the country, both in terms of advances and deposits. It has a network of about 22,900 branches, about 65,000 ATMs, and internationally present with 245 plus branches in 29 countries. So that's the expanse of the bank. And we have Mr. Amara today, who looks after international banking, global markets, and technology.
Yes.
Very, very important functions for the bank, sir. Mr. Amara has risen, through the ranks at SBI, and he joined them as a probationary officer in 1991, and is now the managing director of the bank. Prior to this, he was the deputy managing director and the CRO, where he was, responsible for fortifying the risk management functions of the bank. And before that, he was the MD of SBI Cards, where he led operational financial efficiencies and solidified the market leadership position of SBI Cards. Once again, thank you, sir, for coming on for our very first episode. And I start the conversation, by really, before we get into the world of banking, want to really understand from you your career journey, when you started, and, how have you risen through the ranks, what has helped you in doing that?
Thank you, Revati, for inviting me to your first podcast. And I wish all the best for this program going forward as well. Part of my journey you have already covered, so I will try to encapsulate my 34 years of journey in SBI in maybe 2 to 3 minutes. So, as rightly said, I joined the bank in 1991 as a probationary officer. Typically, bank recruits something around 400 to 500. The number increased over a period of time later. Every year, certain number of people join the bank. And we are identified in the bank, in our journey with the bank by that batch year. So we belong to 91 batch. So obviously this word comes very frequently whenever there is an informal sitting to identify who else are there from 91 batch. So it builds a bonding actually among the batchmates. The typical onboarding journey in the bank as a probationary officer is almost structured on the lines of civil services. Almost we are given like around 20 weeks of formal training in a classroom. We are exposed to the product knowledge and a lot of services what the bank do, and of course the evolution of the bank and the policies, processes, etc. But remaining about 1.5 years, we spent actually time in various types of branches. I'm talking about the first 2 years essentially. These are like some advances oriented branches where you have a lot of loans are there. Some are like branches with intensive trade finance kind of transactions. Some are like branches which cater to a government business on a large scale, etc. Idea is to give us a kind of grounding in all facets of banking in the shortest possible time so that we are ready for taking up the next assignment. So after 2 years, we are typically given one portfolio for which we are responsible, and we have to handle it for about 2 to 3 years. It can be a dedicatedly working for loans, sourcing the loans, processing the loans, etc. Or it can be for managing the general banking operations, more of an operations management in the branch. And once we are through with that assignment, then we are also given an opportunity to become branch managers. So here the role comes like you will be heading a small team, and then you are responsible for end to end. You are responsible for business, meeting the targets, and of course you are also responsible for the operational management. It's a dual role actually.
Yes.
So that way I had done multiple stints. I spent almost 15 years in operations before moving to corporate center. So from 2006, I spent around 6 years in the corporate center in various departments. Initially in change management department, another 3 years I spent in credit risk management department as well. The beauty of corporate center is actually when you are in operations, you become so siloed that you become so target oriented. Your sphere is so limited. Always focus is on execution and meeting the targets. But the moment you come to corporate center where you have to frame a lot of policies which can impact operations at the branches, one has to be mindful of the impact of the policy. That means one has to be familiar with the regulation, one has to be familiar with the opportunity, and one has to be very clear about the appetite. I mean, what is the customer segment we want to target? What is the opportunity size? So one develops a process of thinking end to end and collaborating with other stakeholders also to contribute to the policy. So my 6 years of stay in the corporate center actually helped me to become a better person, a all-rounded person, and that also gave an opportunity for me to go abroad for about 5.5 years in US. So this is again a stint, again memorable stints. Actually, for about 1.5 years, I headed a Chicago branch. Another 4 years, I headed a small subsidiary called SBA California on the west coast of US. So this is a very peculiar in this setup. It's 100% owned by SBI, but incorporated as per the local US laws.
Okay.
So even though it is a small bank, it has its own branches, around 10 branches it had at the time. It is led by a board. I am part of the board by virtue of my executive position in the bank. Then responsible for stakeholder management, responsible for devising the strategy, taking the board along, and then leading the team, which is way different from the Indian team because I'm working with the local team. So here, I think I picked up a number of things thanks to the bank. Actually, it gives you a lot of challenges, but provides a lot of support, excellent support. And a lot of credit goes to the bosses under which I worked, who actually spotted the talent in me, but gave me challenging assignments. But they were always there. You can always lean on them in case of need. So such kind of bosses I was fortunate to get. So it's a very long history. I mean, a long journey in the bank of 34 years, and this thing shaped me as a person. I mean, I evolved over a period of time, mostly influenced by bank life I spent in the bank as well.
Great. So as I see it, you almost traversed all the functions in banking, whether it is operations, credit risk, policy, international banking, rural banking, So almost all teams or departments is where, I think that's amazing because that makes you, in fact, when we speak about, SBI per se, we think that, it makes you a complete banker. And that's something which is different from some of the other private sector entities where you're kind of confined to a specific function. So what are the major lessons that you learned during this whole journey? It's a 34-year long journey, and what you to define as a defining moment that changed your leadership style and how you kind of now conduct yourself.
I think each of my assignments, which number maybe 12 to 13 kind of different assignments what I handled, I think each assignment taught me so many things. Maybe as a junior officer when I was working in a small rural and semi-urban branch, uh, because in such a setup, we are the biggest stakeholder in the local economy or the local community. It comes with a humongous responsibility to help the community, and also you can also develop the bank. But there I realized like if you can provide timely assistance to the needy, whether it is a farmer or whether it is a small MSME customer, I think it brings about a lot of change in them actually. A lot of people flourish based on that assistance what we provide, and they will remember forever. So I still, I mean, very vividly recollect, even though it is 20 years old almost for me as a branch manager of a small branch, but still I can recollect some of the very good experiences I had.
The impact you made on their lives.
Impact I made on them, or I could make on them, thanks to the bank. And at a very, very senior level, of course, it is like particularly I can recollect my experience in US, where when I worked with a very, very different team, a local team, it comes with a different responsibility. You cannot do a micromanagement. You have to believe in their expertise because you have hired the domain experts. You have to give them the targets, but you cannot do the micromanagement. You can only hold them accountable. So it is more of an art as to how you are dealing with them. But again, leading the team and still as a combined team, you have to deliver the result. So giving the autonomy, but at the same time holding accountable is one quality I realized. Because this happens as we are moving up the ladder, we will be leading a larger teams, and it's not possible to do micromanagement kind. So it is only like a it comes with the principle of trust but verify. So
True.
you trust the team, but once in a while you do some dipstick kind of
Yes.
study to figure out whether what you expected is happening on the ground or not, and take some corrective steps.
Correct, correct. That's amazing. That's amazing. So, when we, as a rating agency, also we kind of are very ingrained with the credit in the economy. And when I look at the Indian banking system, it's a very, very vital and important part of the economic infrastructure in the country. Comprises of public sector banks, private sector banks, foreign banks, regional, rural banks. Each bank style has a different role to play within the ecosystem. But when I look at the banking system and the way it has shaped up over so many years, it has become more and more resilient as the economy moves forward. If I look at just gross non-performing assets, it's about 3% of the banking system. If I look at non-performing assets, historical lows. RBI itself is coming out with a commentary that the Indian banking system is very resilient and it's very well capitalized. So, in that context, how do you see, while India's economy has shown remarkable growth, how do you see the banking system evolving, in the next 3 to 5 years?
I think, as you rightly said, we have moved away from the problem of twin balance sheet disadvantage to twin balance sheet advantage, because corporates are relatively less leveraged. Bank balance sheets have strengthened. The FSR kind of report what RBI publishes, reconfirming every time, every 6 months, that actually system is resilient and it can take care of the normal shocks without any serious impairment in the capital adequacy, etc. I think banks have learned the lessons. What happened when particularly you talked about a highest GNPA sometime back. It is 2018. As part of, as a fallout of AQR, a lot of banks have reported huge NPA. Some of the banks have reported losses. I think since then, a lot of structural underpinning has happened in the way we were underwriting the corporate loan. So, in fact, we were pioneers in the industry to start what is called, at least among the public sector banks, to start what is called a credit review department, which actually looks at each of the proposals in a microscopic way, of course. Brings out like what are the risks involved, what is the extent of mitigation provided, and what is the residual risk. So they very clearly articulate whether a proposal can be undertaken or cannot be taken up kind. So clear go, no go kind. And within the go proposals also, they actually risk rate, whether it is a high risk or medium risk or low risk.
Okay.
This is a completely an independent entity, nothing to do with business. Okay. So that way they have that autonomy. So now the committee which is sanctioning these loans of hundreds of crores has the benefit of not only looking at what the business is saying in terms of in support of the proposals only, but they also have the benefit of consuming the input from this credit review department. So they are able to take a more holistic call. They have the 360 view of the entire proposal, and of course, even some high-risk proposals also will be taken up where the committee is convinced with the mitigation that is provided and the track record and the relationships kind. So this model has worked very well. That's the reason you see like the slippages in the corporate portfolio for almost all banks has come down drastically.
Yes.
As you rightly said, GNPA is trending even below 3% for the sector, and for us also it was trending almost at 2% as per December result.
Right.
I think now this model has been replicated in the public sector banks as well, other public sector banks. So this is a kind of structural underpinning. Another big change that happened is the digital underwriting. So thanks to a kind of a push to digitalization that happened in the economy, a lot of unstructured data, digital footprint is available. It's not only the transactions in the core banking system, a lot of unstructured data, the behavior in the social media, purchases, etc. These are all available, which is being consumed using the AML based kind of algorithms in underwriting even new to credit customers as well. So this, I think, of course, every bank is at a certain level of maturity, but largely banks have invested in the digital and the technology and believe in creating end-to-end digital journeys. So this, which started from a small retail customer where you want to give a few lakhs unsecured kind of loan or a credit card, has now switched to even MSME, because traditionally MSME is an area where the TAT involved or the turnaround time involved in actually dealing with the proposal, finally culminating in a sanction, it used to take a few weeks. But now with the benefit of all the digital data and this AML based kind of algorithms, we are able to arrive at the decision using the business rule engine very, very quickly, only leaving a very small part to the team in terms of conducting a pre-sanction inspection, satisfying themselves about the bona fides of the customer. And you may be surprised, actually, we were able to underwrite loans up to 5 crores using this BRE business rule engine just in a day.
Wow.
Just in a day.
Wow. So that's the use of technology that the bank is.
That's the use of technology. So increasingly, people will start using them. Of course, if we talk about like a next 3-5 years, what will happen? You cannot help avoid talking about Gen AI, right?
Yes, Gen AI, correct.
So obviously, I think while AI has been in use, because I refer to those algorithms where AI ML is used, Gen AI can actually has the potential to improve the productivity. So a lot of use cases are being experimented in the industry. I think a lot of people are trying to evaluate whether they can be operationalized at a commercial scale or not. And the advanced AI, what we call agentic AI, has the potential actually to automate a lot of back office activities seamlessly. So I'm not saying like it will be replacing or anything. I'm only saying like this will be a tool which will enhance the productivity, and the teams will start spending more time on the value added part. That means relationship building, or kind of advisory kind of services with the help of the inputs from the AI models, etc. They will be able to do it in a better way, actually.
Right. And so, any specific use case where you're really working on right now, which you think is something with Gen AI would be very efficient in usage?
I think a lot of fintechs, NBFCs have already started using Gen AI in their call centers, particularly for responding to the routine queries of the customers. This is a proven use case in call centers.
Right.
But other experiments are going on in various other areas. I think everybody is experimenting, taking the help of consultants and doing a lot of something in the loans. I mean, maybe Gen Age is generally good in summarizing, actually.
Yes, yes.
So some people are experimenting there.
So the face of banking is going to change in the
I think
next 3
maybe
to 5 years.
Perhaps it is positive in the sense we'll be spending more time seeing the customer eye to eye and actually interacting with the customer more than spending time in processing, actually.
Right.
So
right.
that part will be taken care of by AI, so
Right.
leaving you more time actually for
That's great.
interactions.
That's great. So, how the other thing is, because you look at technology, you also look at international banking, global markets, right? So, how are you seeing, there's a lot of geopolitical changes which are taking place today as we speak. The tariff wars which have been imposed on the world, the behavior of developed economies and emerging economies. So how do you see these impacting, these global strategy shifts which are happening, impacting Indian banking systems?
I think the developments will be impacting Indian banks in different ways for different banks, depending upon their exposure to international operations. As you said in the beginning, like we have physical presence in almost 244 physical locations in about 29 countries. So we have the largest international presence among Indian public sector banks. So we have a established system. We have every year we look at in terms of how the overseas operations are doing and what is the scope for further expansion, depending upon the regulation, depending upon the opportunity size in that country. We look at how do we expand, or what are the new lines of business we can enter into, or otherwise wherever we feel like if it is not viable, then obviously appropriate call will be taken to limit it to a particular set of operations. But one area which will be common, including the domestic oriented public sector bank, also will be like a trade finance. Because some of the customers who has been dealing with certain countries because of this global trade war that's going on, or realignment of the supply chains, it is possible like their existing customers may not be dealing with the same countries.
Correct.
Or they may be dealing with the new countries, etc. So
Correct.
it is time to work with those customers, to be in touch with them and to facilitate. So this is a task for everyone.
So new trade relationships will get
New
established.
trade relationship also. This is the result of that realignment in the global supply chain. So,
absolutely.
But hopefully, majority should remain in the same way. I only hope like some middle path will be there, and our country is proactively negotiating with the US in terms of entering into a bilateral trade agreement.
Yes.
And also in negotiations with so many countries like Europe, etc., European Union for trade agreement. Hopefully, these should fructify and the core part should continue. But of course, some 15-20% change will always be there.
Okay, great. So, let's turn back to the Indian banking environment. We've seen a lot of regulatory changes which have happened in the past few months. There were two policy rate cuts. Then there was a liquidity injection into the system. There was a deferral of certain processes like ECL or provisioning based on infrastructure sectors and all that. So how do you? But the credit deposit ratio, which has been a cause of worry, has been trending close to 80%. Even now, it kind of dipped to 79% in the last fortnight. It's trending close to 80% consistently for the past 6-8 months or so. So how do you see, the Indian banking system reacting to this liquidity issue that has emerged, and how do you see this issue going ahead?
I think it has two parts, if you ask me. One is like the deposit growth lagging the loan growth till recently, but of course now we are seeing a kind of small convergence between the deposit growth rate and the loan growth rate.
Yeah.
And of course, the second part is the growth-inducing measures taken by RBI, particularly on the liquidity front. So if we talk about the deposit front, I think we are no exception to the industry. We also had the same experience, but now the situation has improved. But it is not in line with the rates what we used to see, the growth rate what we used to see till 2 years back or 3 years back. So obviously then this is a result of that financialization, where the retail deposits are now increasingly moving to either term deposits or otherwise directly to the markets, either through mutual funds or direct investment in the markets.
True.
So now there is another opportunity where some of this money anyway from these market intermediaries will come back to the banking system. So whoever will be able to tap this money, for them the growth will continue. But in this process, what's changing is the color. Maybe a retail deposit is now taking the color of a wholesale deposit from an institution, right? With the corresponding change in the tenor. Maybe earlier 3-year deposit or 5-year deposit are quite common till few years back. Now we are seeing a trend where increasingly depositors are happy to keep only for 1 to 2 years. And the kind of special deposit schemes that came in last 1.5 years, 444 days, 400 days, 360, 370 days, or whatever it is. I think banks have also played the game, understood that perhaps they may have to pay more, but limit the risk by limiting the tenor. So I think this now will slightly get corrected, because now the transmission is also happening thanks to the additional liquidity support, supporting measures taken by RBI. We are already seeing the transmission happening, because if you look at the call rates, or otherwise if you look at the TREPs or otherwise Chrome's kind of rates, they are just aligned to the repo rate. And particularly the markup that used to be commanded by CPs and CDs, that markup has also reduced. And a lot of banks have already announced a reduction in the deposit rates, including some banks in the savings bank deposit rates
too.
So the transmission is happening already. So the rates will tend to come down. And inflation forecast from RBI is also very
it's benign. It's close.
It's benign.
Yeah, it's benign. That's true.
So the downward bias is there on the rates as of now.
But if I look at, and you rightly said, there were innovative periods which banks kind of look at raise deposits, and they were at pretty high costs in the last 1 year or 1.5 years. And these deposits are there to stay with the banks, right? So with the policy rates coming down and the transmission going on, the lending side also, obviously, you will have to give money cheaper than what you were giving at the point of time when you raise deposits. So how is it going to impact the NIMs in FY26? How do you see that happening?
I think, it is a general belief, it is a known. When the rates were rising, I think the system was also the beneficiary because of the same lag effect, where the rates were not getting transmitted. On the loans, you were getting the benefit to the extent the rates are linked to the external benchmarks. That portfolio was getting repriced, but deposit rates, the transmission did not happen automatically. There was always a lag. So is the case now, where it will work in a reverse way, where you would perhaps the deposit rates may remain slightly elevated, but part of your loans portfolio getting repriced because of a reset in the repo rate, or if it is a T-bill linked kind of portfolio, whenever the T-bill rates are down, obviously it will get transmitted. So it is given that some compression will be there. But it all depends upon how you are pricing the loans. And to your point, like whether we are stuck with a very, very costly bulk deposits and that too for a longer tenor, if any bank is undertaking such kind of activity, they will have more challenge in terms of reducing the deposit cost as compared to somebody who is prudent, who is limiting that bulk deposit also to a short tenor. I think they will have more maneuverability in terms of managing the compression.
Okay. But you see that there will be a pressure on NIMs in the intervening period.
I think that will
That
be
would be
there
there.
if the rate cuts further continue.
Right,
Definitely.
right. And if I look at the other aspect, credit growth
Mhm.
in the economy and banking system credit growth last year closed at around 11.5%. Year to last, it was about 16%. Obviously, significant portion of retail and NBFC credit was something which was not as high growth in FY25. So, how do you see credit growth in FY26?
I think, as you said, growth rates have anyway decelerated, and growth rate is anyway, I mean, system credit growth is always closely linked to the nominal GDP, with the GDP forecast being around 6.5%, which is still I think we are the fastest growing country. We should take pride
Yes,
in that.
yes.
You will have a nominal by way of a markup of another 2%. So if you're looking at a nominal GDP of 8.5 to 9%, it is reasonable to expect a system credit growth of 10.5 to 11 minimum, base case. But the kind of some of the headwinds what we talked around the global trade wars, if they settle down quickly, and if we are able to leverage on the opportunities that are emerging on account of realignment in the supply chains, etc., and the government of India schemes in terms of PLI and in so many sectors, including in electronics, I think if all these things materialize, there is an upward bias on the growth rate. And
Okay.
automatically the system will also support that kind of growth that is needed in the system.
Correct, correct, correct. So, something which, we've been grappling with, while RBI has cut the repo rates twice and it has changed its stance to accommodative stance also, we still not seeing all around growth in private credit. In the sense that the capex has not really picked up to the extent that the economy would require or is thought that would pick up. So how are you seeing this private capex cycle? Are you seeing some green shoots there? Are you seeing private capex returning in a big way since the policy rates are now down, liquidity is available in the banking system, and the corporate balance sheets are also very, very good?
Correct. I think it's a fact that actually government of India was doing that front loading of. I mean, they were bearing the burden of actually making the necessary spends in the infra, hoping like they will be able to crowd in the private sector, which did not happen for some time. But now, for the same reasons what you said, like with liquidity easing and with the cost of capital or cost of debt that will come down over a period of time, and once this uncertainty settles, because any entrepreneur will always look at the uncertainty. Once this uncertainty settles, I'm sure the private credit will come back in a strong manner. In fact, we continue to see a lot of proposals, particularly greenfield projects, etc., happening in the renewable energy space.
Okay.
Electronics, of course, even though it is confined to a few corporate houses,
Right.
still we see a lot of activity. Conductors, we are seeing a heightened activity. Then green hydrogen. I think we are seeing the interest is sustaining actually as far as these are concerned,
Okay.
including in the steel and the one sector perhaps where slightly it was low was the roads. But now with announcement from government of India where they said like they are going to look at the road sector and they are going to ensure 100 kilometers per day kind of roads, which they're targeting. I'm sure again road sector will also pick up. I think it's just a matter of time, I believe.
Okay, that's great. That's great news to hear from the largest bank in the country. Since you've dealt with risk management also, and you alluded that bank is now having a credit review department, and there are use of technology for making better credit calls. We also believe that use of technology is inevitable when we do credit risk management, and we are also trying to inculcate that as a part of our rating process. But how do you use these credit strategies as far as your international banking operations are concerned? Because in domestically you have a lot of data, the digital stack is pretty much there. But because you are spread internationally across so many locations, how do you use those for those locations? How do you kind of use these strategies?
I think if you look at my international book as to what does it comprise, it is almost like equally distributed between the credit extended to the big corporates, Indian corporates, but who are raising external commercial borrowings abroad. That is almost like a one third. Then one third credit is also given to some of the big corporates which are operating in certain geographies like US or UK or Europe, etc., in other geographies, which are the local big corporates who are leaders in their sectors, in the sectors where they're operating, where the loans are syndicated by a big bank in that geography, where we participate either in the primary or in the secondary. That accounts for around one third. Remaining one third is a trade finance, which is purely transactional. So that way, the strategies will have to be like, as far as with the funding for Indian corporate, you continue to look at what matters for that corporate, what is its strength, what is its profile, etc. So the usual considerations will anyway be there. But for a MNC or for a big corporate that's operating in that geography, it's a well developed market there. So, very comprehensive information memorandums will be available to the participating banks where the risks are analyzed based on the risk appetite what you have and based on the view locally one has on that particular sector. Our local offices take a call to the extent of how much they want to participate and what is the size of loan they are ready to bear or underwrite. So that call will be taken locally.
Okay, great. So, ESG is a emerging theme, and the regulators are also seized of that in India. Climate risk financing is also something which RBI has been talking about. So, how are you looking at this piece, and how are you integrating ESG into your lending decision making?
I think very important and pertinent question for the reason. I think we are the most impacted country among several countries in terms of climate change.
Yes.
We cannot deny. We see the heat waves, we see floods, and at the same time in some other part of the geography, etc. So our exposure to climate change risk is very, very high. I think I have to acknowledge here the prudent stance taken by the country as well as the regulator. India, of course, I mean, the government-wise, when I look at it, is trying to balance the interest of the economy, but at the same time, commitments given in the Paris Agreement, etc. So, in a very pragmatic way, they decided like by 2070, India will achieve the status of net zero. In SBI, if I talk about, we have declared to the investors also that we want to achieve net zero status by 2055, which happens to be the centenary year for SBI.
Okay.
So, and I mean, we are very, very conscious, and we also looked at the RBI draft guidelines around the disclosures around the climate change risk, which basically, first of all, encourage. It is not like a stipulation or a prescription. They gave a framework, and they're encouraging the regulated entities like banks to have the basic elements in place. So when I say the elements is more around governance, that means a committee of top executives have to be there in terms of articulating a policy. What is the approach and what kind of approach is there for funding the fossil-based or carbon emitting kind of industries, etc. What is our approach, etc. Then risk management in terms of having a capability to assess the actually what is the carbon footprint in the portfolio itself, whether it is a loans portfolio or the investments. So that means it is acquiring the ability to assess, and then on a each proposal based kind of thing, whenever you are handling a proposal from a corporate, having the ability to measure them on a scale for the climate risk. Where do they stand? Are they on a scale of 10? Are they at 9? Or are they at 3? Or are they at 4? As of now, it is more of an assessment that is being done by the bank. Our idea is to, depending upon if it is a red industry kind, we are engaging with the sectors, we are engaging with the company in terms of what is it they are doing in terms of for reducing their energy intensity, reducing the carbon footprint, etc. We are engaging. Anyway, some of the larger entities, listed entities, etc., they have an obligation to publish the DRSR
reports.
So a lot of data is available,
Right.
but a lot of companies are quite proactive in terms of declaring in their investor presentations also that they're targeting certain reductions for such and such year. So as of now, it is not like we are not saying it is a go, no go. It is more of creating a sensitization within the bank as well as our borrower, customers. So as and when a call will be taken by the other important stakeholders like Government of India and the sectoral regulators, etc., obviously the next steps will be taken.
But are we going to see a differentiated pricing for companies which are compliant or more compliant with ESG
I
matrices?
don't think it will not happen immediately.
Okay.
Maybe over a period of time, once that kind of maturity is there and understanding is also there, and all the elements I said, like I think I'm very happy to note, like I think Government of India has also came out with some kind of targets for hard to abate segments. Some aluminum they targeted, cement, etc.
Right.
Very recently they talked about like targets for
Yes.
this in terms of energy reduction. So as these measures mature and as more players are committed to meeting these targets, then a time will perhaps come to integrate this ESG into the general risk management in terms of very clearly articulating risk appetite as to how much will be funding at what price.
Right.
But that is a bit far away, at least.
Okay. Okay. India has started its own IFC at GIF City, and SBI is present in GIF City. So, how do you see, GIF City emerging as a global financial hub? Because we are trying to, foster that ecosystem to have a credible alternative in the Asia region.
No, we were the first ones to among the banks to start operations in GIF City. We looked at some of the advantages like a unified regulatory authority, and then having the ability to use internal resources.
Right.
So where you have a cost advantage, etc. So we looked at them and we started our operations and we slowly started building the book. But I think I still feel like it is a work in progress. While a lot of, I think there is clarity around a lot of other activities. Even the mutual funds have set up the shop. I think even the other exchanges are also setting up the shop there.
Yeah. We also have a presence
I
there.
think you also have a
yes,
presence
we also
there.
have a presence there.
I think it will happen. Definitely, it will meet its potential, but over a period of time, I feel.
Okay. Okay, great. So I think we've covered a lot, a plethora of topics today, and put you in the spot.
Not bad.
But any advice that you would like to give to young professionals who want to take up banking as a career?
I can only recollect one thing: there is a hunger for learning. I think that has to be there. I think one has to be cognizant of what are the changes happening in the ecosystem, what is happening with competition, and what is the pulse? How is the pulse of consumer changing? I think one has to have that perception and have an eye on these things. If one has that, and does the task as per the policies and internal policies and meet the targets, that's I think they will have the growth.
Great, great. Thank you very much. It was a very insightful conversation that we had today.
I hope it is useful too.
Yes, I'm sure it will be very useful for the audience who's watching this. Thank you. Thank you so much again.
Thank you.